Hey, good morning, everyone. Chris Lopez here, and you are joining us for the monthly March Roundup, where basically Joe and I sit down, have our cup of coffee, have a Red Bull. We talk about the market for the previous month, and we discuss a few deals. So good morning, Joe. Good to have you back.
Good morning, Chris. Thanks so much for having me. Always enjoy seeing you for the monthly Roundup. Really excited. I think we got some good information to talk about today. Pretty excited about it.
Yeah, so for those that don't know me, again, my name is Chris Lopez. I'm a real estate agent at Your Castle Real Estate. I focus on the investment side with house hackers and buying rental properties. And Joe is a loan officer at Castle & Cook, who does all sorts of loans, including investment.
All loans all the time, man. That's all I do. So investment properties, first-time home buyers, house hacking. We help you sell your fix and flips, conventional, FHA, VA, USDA, all sorts of things. You got a hole in your lip there? You just dropped coffee all over yourself. It's just like a real coffee appointment.
This is audio. People can't see me. Do not embarrass me.
That's why I wanted to say it. The viewers at home couldn't see that.
I know. Thank you. This is, yes. Yes.
Glad you didn't get it on all this fancy equipment.
That's why it's raised up off the table, right, so I don't screw it up. All right. So jumping into the market trends for March. And so what we're looking at here is the chart that's like a 10-year history of active inventory versus what's actually sold per month. So a lot of you guys have seen this chart. And what's been really interesting is seeing the data from last year, where about, summer of 2018, we definitely started noticing the market taking a breath and not being quite as crazy with more inventory coming up. And that's kind of normal for that year. And then as we go into fall, we dip down with inventory. But then coming back up as far as the springtime and everything, inventory this spring is still higher than inventory last spring in the last 3 or 4 years.
Yeah.
So basically the same trends we've been talking about the last 4 months in these Roundup webinars with more inventory. We're seeing the same trends.
Yeah, absolutely. We're seeing more inventory come on the market. More people are deciding to list their homes, and we're seeing more opportunities for buyers. But here's the interesting point. I'm also seeing a lot of competitive offers. I had a competitive offer last week, or I guess it was last weekend, $800,000 list price. Our guys offered $835,000. There were 9 offers. It went under contract at $850,000.
Yep.
So you know what that tells me? That was a well-priced property that was highly desired. And regardless of all the other market factors, a lot of people wanted that home.
Yeah, I 100% agree, because we're seeing the same thing. Sometimes we get offers on properties that no one else is putting an offer in. But just, let's see, we're recording this on a Thursday. On a Monday, so 3 days ago, a great property for house hacking came to the market like Thursday or Friday of last week. We jumped over with one of our clients. We put in a very competitive offer, like down on $10,000, $12,000 over list price. We had like a $5,000 appraisal gap in there and a couple other things that made our offer look really good. And when we put our offer in, there were at least 4 other offers and some more rolled in, and we did not win it.
Mm-hmm.
We put in a official backup offer. We were like second best, but the people that won it, it sounded like they had a slightly higher offer price and completely waived appraisal.
Yeah.
So if you still market your property somewhat well and price it somewhat decently, you will still get multiple offers. So
absolutely,
good time to sell it correctly.
Right.
But as a buyer, hey, you have a couple more hours now to make decisions, a little more wiggle room when it is negotiating.
Yeah. I think the message I would say is there are more homes to look at, but the primo homes are going to go quickly still.
Yeah, I would agree with that. So this is a bar graph here just showing of March 19 all the way back to March 18. And what you see here are active is up. Active for March of 2019 was about 6,300. That's total active inventory of residential. So detached homes and like condos and townhomes. So basically single unit properties. And then March 18, we're at 4,600. So 6,300 this March versus 4,600 last March. Now our new listings, actually pretty close. So this March we were about 6,200. Last March we were at 6,400. Now under contracts, we're about 5,650 for this March and about 5,400 last March. So slightly more under contracts. And then if you look at actually what was sold during March, this is the most interesting stat to me for what we're talking about in the market this time. In March 19, so last month, we were at 4,162 residential units sold. So 4,162. last March, we were at 4,714. So last year we sold about, 60 more homes or so?
About 600 more homes.
Am I doing my math right? Oh, yeah, 41 versus 40. Yes.
Hey, can I see the mouse? That way, when you're pointing these out, I can highlight.
Yes. I thought you were saying, could you see the glasses to fix fix my eyesight or anything?
So no. I'm not picking on you. So this was last year, 4,700 sold homes. This is this year, 4,100 sold homes. So what does that tell us, Chris?
That we're selling less homes, which is tremendously surprising to me, because if I had to make a bet, if you and I were betting $10 or whatever, I would have said, hey, we're going to see more homes sold for two reasons. One is inventory is up, so all that pent up demand, people can go out there and be a little pickier and kind of gobble those things up. But the big reason I thought units would be up, or units sold would be up, is because interest rates have really dropped here in the last, was that 2 months or so?
Yeah, about the last 2 months, interest rates have been very low.
I mean, I know that's made me excited, made some of my buyers excited. I just thought overall as a market, we would just see a lot more sold with those two things going on.
Yeah, it's very interesting. But I tell you, I think we're really now getting into the big swing of things. And one of the points that I always look at is what we see right here in closed transactions. How long does it take to close a transaction on average, Chris?
About 30 days.
About 30 to 45 is the industry average. So everything that's closing right here in March actually went under contract somewhere over here in January, February.
Yep.
Right. So I expect that all these properties that came on the market here and even somewhat here, we're going to see over here in April, we're going to see some increases in closings for April and May would be my prediction.
So your prediction is that April, May of 2019 will have higher solds than April, May of
2018.
Last year.
Yeah.
So
we'll have to listeners out there, check us next year or next month, see if we have more than 4,900, and then the following month more than 5,700 sold properties. Now that's just a speculative, I'd say a guess, but I think it's backed up with some data.
Yeah, no, I agree with you there. I'm just, because I know that with that rolling time frame we have, inventory's been up, mortgage rates dropped. I thought we started seeing a higher tick up here in March. So I'm very interested to see what April and May's data is like.
Yeah.
But I agree with you. I would be really surprised if it's not greater than it was last year.
Yeah. Yep.
But that is our best guess. Don't put any money on that. And regardless, here's a bottom line. It really doesn't matter, because it's still a great time to buy properties in Denver with interest rates dropping, inventory up. I mean, I still see nothing that says, hey, the market's going to crash or we're going to see dramatic price drops. Basically, prices just aren't increasing as quickly as they were the last few years. And my guess is that trend will still continue.
I agree 100%.
So this next slide has a couple of data points. We basically talked about all of them. One thing on here that is worth highlighting, I think we kind of hit that in the last data slide. Days on market has gone up some. But other than that, that's the only thing we didn't discuss. So days on market for this past March was 31 days on market average and 27 days on average for last year. But days on market for median were 10 days median for this March and 6 days median for last March. So both have ticked up slightly. Percentage wise, if you look at the days on market median from 6 to 10, it's like a 66% increase. But that's also just because the number is so dramatically low. But this makes sense because inventory has increased.
Yeah, absolutely. It's these numbers over here, like the year over year changes. These are the numbers that I think you want to be really cautious with, right? A year ago, it took 27 days to sell a home. Now it takes 31 on average. A lot of times you might see an article in various publications. They say, oh my God, days on market is up 15%. The sky is falling. It's going to take you 15% longer to sell a home. All right, that's probably true this year. 15%, it's only 4 days. 4 days, that's like half of a work week, right? It's not anything to panic about. So just be aware when we see these percentages, always look at the underlying data behind it.
Exactly. And the last thing, we said this last few months, even though the market is slowing down, if you take a step back and look at the big picture and kind of the historical trends, we are still in a seller's market overall. So even though inventory is up, days on market is up, price increasing is not going up as fast, we are still solidly in a seller's market when we look at all the data.
Yep, absolutely.
So here is a chart we always like to cover. This is internal data from Your Castle Real Estate, where they actually track the number of showings per properties that are listed with their agent. So Joe is highlighting the 2019 numbers. And right here in March, we're about 17, 18 showings per property, which is better than all the recessionary years back in 2010, 2012 type time frame, but not as much as 2018, 2017, and 2016. And I think this is really just a big reason we're seeing a lower number of showings per property. Is because we have more inventory out there now.
That's right. Yeah, there's just more homes on the market.
Yeah.
So if we've got the same number of buyers, you have fewer showings per property.
All right, Joe. So since we have been talking about interest rates here for this podcast and the last one, we got some interesting data on mortgage rates, and this is definitely in your court.
Yeah.
So give us perspective on here.
Yeah. So what this is a 10-year chart. It goes all the way back to January of 2008. We all remember this volatile time in the market. And at the time, interest rates were 5.5%, 6%, 7%, 7.5%, depending on the day. And the bottom fell out of everything in 2008, 2009. And then you started to see these big drops in interest rates, a few spikes here and there. But for a long period of time, interest rates remained very, very low. Had a little bit of an increase in late 13 or middle of 13. Then we've kind of sort of floundered here for the last, 4 years, below 4%, just above 4%. Then we started to see sort of a gradual trend upwards over the last 2 years. And then what do you know? A few things changed in the economy and perception, and interest rates really started going down very significantly. And so as of a month ago, we were at the lowest level that we'd seen in more than a year, which was great. Buyers were very excited. Sellers were excited because they were like, oh my gosh, my buyer can maybe afford my home now because interest rates are a little bit less. But here's an important point to understand. Interest rates in this chart is always backwards looking. If we look at interest rates today, we're already starting to tick up a little bit. So don't look at this and say, oh, that's great, they've got so much further to fall. Probably not. I think this is going to be, when we look at this chart next month, you're going to start to see this was right about the bottom at the end of March, and interest rates are starting to go back up again. So it's very interesting. The stock market, interest rate market, it moves so quickly and so volatile, but it's always easier for rates to gradually go up than it is for them to come down. So if you are thinking about buying, I always encourage you lock in your interest rate, because the odds of rates going from here down are pretty slim, but the odds of rates going from here up pretty high.
And regardless, as we flip through the next slide, like I've talked to some people and they're like, oh, I missed it. We're now above a 4% interest rate. The good old days when it was like 3.75, it just makes no sense more to buy a house. Yeah. I'm like, whoa. Perspective.
Right.
So this chart shows some perspective, Joe.
Yeah. I mean, let's go back to the 70s. Average interest rate was 8.9%. 80s, average rate was 12.7%. If I told somebody today their interest rate was going to be 12.7%, they'd probably call the police. All right. 90s,
I think I can get a better rate on my credit card.
You must have really good credit.
Yes.
Yeah, probably do. All right. 90s, average interest rate 8.1%. 2000s, this is right when I got in the mortgage business all the way back here in 2002. Average interest rate was about 6.3. And now for the last 9 years, since 2010, average interest rate's been about 4.1.
So back when you got in the market, back when they were averaging in the low sixes, what were people saying about the rates? What was the general?
It's the lowest they've ever been.
Yeah.
Yeah. So right here, I started the mortgage business in 2002, right there. And everyone said, oh my God, this is the lowest mortgage rates have ever been. I have to buy. I have to refinance. This is so great. This is the time to do it. Guess what I've heard every single year for my career? Oh my God, this is the lowest rates have ever been. Oh my God, this is the lowest rates have ever been, until right here. Oh my God, the market is over. You can never afford to buy a home again. Oh my God, interest rates are the lowest they've ever been. Oh my God, the market is over. You can never afford to buy a home again, right? And so this sentiment, you see it. And the message that I like to put out to consumers is you should not decide whether or not to buy a home or not buy a home based on interest rates. You should buy a home based on your personal situation. Do you need a place to live? Is it a better investment than renting? And does it make sense for your long-term plan? Because you know what? I know some people that bought homes in the 80s that are now very, very wealthy, even though they had to pay 12% for a certain period of time. Let's say you get this interest rate today at 4.1% or whatever it is today. If rates continue to go up, that's inflation protected. It's never going to increase if you get a 30-year fixed. And if rates go down, you have the opportunity to refinance and decrease it. Now, rates going down seems pretty unlikely looking at a past 40-year history. Generally, rates are higher than this line of where we're at currently. But still, I think it's a great time to buy a property, and really try not to focus too much on, oh my God, is my rate 4.1 or 4.2? Oh, it's 4.3. Well, that's it. I'm not buying. That's not why you buy or don't buy a home. You buy or don't buy a home because you need a place to live.
Or a place to invest.
Right.
Yeah. Cool. Right. All right. Yeah. So this is really good perspective, guys. And this is what we've talked with clients when they start getting in the, kind of fixated on rates is, hey, take a step back, look at historically speaking, because my bet is if you lock it anywhere, whether you got 4.1 or 3.75 or 4.75 as an owner-occ house hack last fall, in 20 years, you'll probably be happy. But God, remember when the rates were that low?
Yeah. Oh my God. Remember when when I got my first mortgage at 4.5%? I still have it. Yeah. It's crazy.
All right. So moving on to our deal analysis. So on today's webinar, we're discussing two deals. One is a house hack and one is a straight rental property. So this first house hack is actually up in Westminster near 80th and Federal. So it's a 3-bedroom, 2-bath. It was listed for around $350,000, and we got it for in the low 360s. So we did get into a bidding war. There were multiple offers. And then interesting, I can't remember the details of this property, but it's kind of funky. If you ever look at the MLS and price history, it was listed last fall for a really high wonky number, never did anything, drop, got withdrawn. A few months later, it was listed by a different agent that was, I think, much better suited for listing that property or just listing properties in general. Listed it very well, did a good job with the description, not a great job with the photos, but hey, I'll take those when we can get them. So the reason we like this, and I'll kind of give more details on those numbers here in a minute on the next slide, but the reason we liked it is because it is just a phenomenal layout. So what one of the previous homeowners did, it's a ranch style home, and it looks like they had taken the existing garage, converted it to a living space and a hallway, then added on an additional garage next to it where the parking pad used to be. So it's actually got two separate entrances from the front. And basically the left entrance takes you into the main part of the house upstairs. The right entrance takes you part into basically this kind of shared hallway that went along where the old and the new garage were, where you could access then the top floor or go down the down floor, the floor in the space in the basement. And then if you walk through the parking pad, which is on the other side of the garage, there is another entrance out back, which is another way to get into the property as well. And another reason we liked it was very easy to add a fourth bedroom, not fourth bathroom on the slide, the fourth bedroom, because we just need to install the clients need to install an egress window. And then the property definitely needed a little bit of cosmetic touching. This is one of the reasons we really liked this property, because it was a solid property. It just didn't show very well. It was one of those properties where they just did a half-assed job of painting. There were seriously a couple walls where 3/4 of the wall were painted, and you could see the roller marks kind of still going over the other one, but they never finished it.
Oh, yeah.
And so there are a couple walls like that, which, is not a big deal. But for the typical, homeowner that just wants to move their family in there and get a place, it's just a turnoff. And they say, oh, my gosh, this property must have so much work there. We saw it. We did a walk around wow, this looks really good. We expected some quirks with this older home. It's a house hacking home. Yeah, they have quirks. But overall, we're oh, this is all just simple cosmetic stuff. So we wanted to go in there aggressively. And here's the way it played out. So the investor or the house hacker I worked with, this is not her first rental property. It's her first house hack in Denver. She owns 1 and 2 rentals from out of state from where she came from, but she's here in Denver for a while and she wants to start getting into the Denver rental market. So, she knew what she wanted, and she knew, hey, this property is a winner in the long run. Let's go on there with a strong offer. So there were multiple offers on the property. Like I said, the list price was around $350,000. We came in I don't know, somewhere between 10 and 15 grand above that. Can't recall the exact numbers. But in that multiple offer situation, we won. And part of the terminology we put into the contract was, hey, we'll do a limited inspection to health and safety items. And then we're buying the house as is. So I'm using air quotes on as is because it's always in the contract. But agents and buyers and sellers often like to put it in there again, and they think it really means something. In reality, it really doesn't mean anything. So we say as is because basically that means us, hey, we're not going to nitpick you on things unless there's something major. Hey, we might come back and ask, we'll terminate on the property. But when we do offers like this, what this tells the seller and the seller's agent is, look, we are not going to nitpick you about things. We are not going to worry about this or that, but if there's major health and safety items, we may ask you to come back and work with us to get those resolved, whether it's fixing them or giving us a credit. And of course, we always have, even though we say that, it always leaves multiple outs for the buyer, where if we get under we do the inspection, and it's just horrible, cool, you can terminate and get your earnest money back. But typically, before we terminate, we always go back to the seller and say, hey, look, we like this property, but hey, there are a couple of things we didn't realize. So here's what we want. At that point, we can either renegotiate, and if we can't come to terms, we terminate. So either way, the buyer is protected. So we often run our offers like this because we like to be aggressive and show the sellers that, hey, we want to buy this property and we're going to buy it in good faith. But if anything major comes up, hey, we're going to come back and talk to you about it. So part of the condition was the sellers had already told us this in the listing, was that the roof had hail damage from a previous hailstorm, and it was covered by their insurance. And so this is, middle of January, and this winter we definitely had a winter and we had quite a bit of snow. So we knew we had to get the roof replaced, and the seller was going to take care of that. But we were not going to close on the property until the roof was complete for lending reasons and the new buyer's property insurance reasons. So that actually pushed out the deadline. It was one of the reasons why we actually didn't close on this until sometime in March, because we had a few snowstorms that delayed getting the roof put on there. So when we did our inspection, all the normal stuff pop up. If you guys have ever read the inspection report, it's a lot of photos, a lot of red circles and red print that makes it look very dramatic. But all that normal stuff you see, but we had three main concerns in there. One, in addition to the inspection, I always recommend my clients always do a radon test. That's $100-ish, and always do a sewer scope right around $100 as well. So we had high levels of radon. They came in at 7.1, and the EPA says anything above 4.0, hey, that is a health risk. So high levels of radon. So that's obviously a concern. There was an old Federal Pacific electrical panel. So obviously we don't want to keep that long term. And the sewer line. So this was a very interesting thing on the sewer line because I can't remember quite where it was mentioned to us, but it was basically said, hey, the sellers had the sewer scoped recently and it all looked good. Cool. Take your word for it. But
can I get a copy of the scope?
Exactly. And still, hey, cool. Maybe you scoped even a month ago. Hey, buyer, still scope the sewer because who knows what happens in between. That's $100. And if you have to fix the whole sewer line, that can be $5,000 to $20,000, if not more sometimes.
Let me ask you, just as a side note, do you advise your clients to get a sewer scope?
Always.
Me too.
Even if it's a brand new property, get a sewer scope. I've heard one horror story where it was a new build. I was talking to an inspector. New build, they had the brand new sewer pipe running out, but someone forgot to hook it up to the main sewer line.
That's right.
So you want to check out this.
Guess what? You get in there and you live in that home for about a month. That's going to back up, and you're going to be living in some filth.
Yes.
And it's going to be expensive to fix.
Yes.
And once you own it, you fix it, not the builder.
Yep. So guys, whether you work with me and Joe or not, always do a sewer scope, always do a radon check. Just, it's good sense. Yep. But then what happened is we did the sewer scope, and the sewer was not in great condition. It was nothing bad, but it was definitely as an old sewer line. There were some issues on there. And, it brings up this interesting thing is where, hey, the sellers told us that there was an issue on here, but it was actually not, or they said they scoped it and that came back good. We scoped it, definitely was not. And anything we're mentioning the sewer was not disclosed on the seller's property disclosure. So, we kind of had a couple conflicting messages. Oh, the sewer's fine. We did the scope, but it's not fine. And you did the scope. So did you actually know there was something wrong, or didn't you? So in a very polite way, we asked, hey, Mr. Seller and Mrs. Seller, why wasn't anything about the sewer mentioned on the seller's property disclosure? And so I think because of that, they actually never gave us back an answer. But they just said, cool, all your inspection items, which was a radon system, replacing the Federal Pacific electrical panel, and fixing the sewer line, we asked for $9,500 in credits. We were hoping to get like 1 or 2 of those things done. But I think since there was some miscommunication over the sewer, they just gave us the full $9,500 credits.
That's a deal.
Yeah, well, if we really wanted to, kind of like make a stink out of it, you told us one thing, but it's not disclosed on the seller property disclosure,
right?
You can get in some trouble there.
That's right.
So
P.S. You're gonna have to disclose it to the next buyer if we cancel.
Exactly.
Right.
So, and again, we weren't trying to, we didn't want to cause any issues. We just wanted to do the best thing for our buyers. So we politely pointed these things out, said, hey, here are the things we wanted. We're buying the house as is, but these are 3 things that we could not see through a walkthrough. So we want these resolved. And so generally speaking, most of the time we actually just ask for credit and let the buyers go out there and do the work themselves for 2 reasons. One is they may actually hold off to do the work for a while, but also they may want to do other work, and they can also make sure the work is done to their standards. Versus like, oh yeah, whatever, just get it done, get the cheapest thing in there so I can sell the property, where the buyer wants it done well and to their standards. So we got the full $9,500 in credits, which was wonderful. So we were very, very happy. So this brings up an interesting scenario then, because we were doing a 5% down conventional on this property, which is kind of our go-to for house hacking properties. There's just 5% down conventional. And Joe, if we're getting $9,500 in credits, how does that play out when we usually have like $4,000 to $5,000 in closing costs and prepaids and everything?
Yeah. So an important point, when you're getting a concession from the seller, that needs to be used to pay closing costs. It cannot be used to pay anything else. Cannot be used to buy carpet, cannot be used to repair the property. If it's a repair, it needs to be done prior to the closing. But if the seller is saying, hey, I'm going to give you $9,500, you have to use that towards your closing cost or reduce the price. So maybe you had a loan that has $5,000 in closing costs, pretty common number. You could say, hey, I want $5,000 towards my closing costs, and I want the price to be reduced by $4,500. Great. We're going to put that in and amend, and we're going to do that. Or we can say, hey, we want the full $9,500 to be used towards our closing costs. We currently have $5,000 in closing costs. Then you call me, the lender, and say, hey, Joe, we've got $9,500 concession. Can we use that to get creative and benefit ourselves? A quick one that you could use is, yes, we can get you a lower interest rate and use that additional $4,500 to buy down your interest rate. That's A. B, could we use that $4,500 and pay upfront mortgage insurance? Just pay the mortgage insurance one time. So really the seller's paying it, and then you don't have it on a monthly basis. That's a great option. Or then C, the first one we spoke about, what is the impact if we just reduce the purchase price by $4,500? What does that do to the payment? So we'll look at all 3 of those scenarios with you and figure out which one is going to be the most beneficial for you to use.
Yep. And generally speaking, as far as a monthly cash flow, it's prepaying PMI or buying down the interest rate is going to have a more significant impact than reducing the price by a couple $1,000.
Exactly right.
So here's actually the numbers from this transaction, because Joe was spot on. Closing costs for this one was, so we have $9,500 to use. So closing costs were $2,847. Prepaid, so this is like property insurance for the year, escrows for property taxes, and then also prepaid insurance for the remainder of the month was about $2,540. And then we got a property tax credit from the sellers because we were already through the first couple months of the year. So we got $400 back in a property tax credit. So that was kind of the money they had to bring to close, which was $4,987. So about $5,000. So $5,000 minus $9,000 or $9,500 gives us about $4,500 left over to use. And as Joe said, if we don't use the buy down a point, prepay PMI, or reduce a purchase price, you either use it or you lose it.
Goes back to the seller.
Yeah,
that's
and
right.
We want to use it.
That's right. We negotiated for it. We want to spend it.
$4,500 is a lot of money. If it's $20, yeah, who cares? $4,500, we care about that. So at the time, the current principal and interest payment, so PI payment, we were at 4.75%. Which is going to work out to a $1,810 a month payment for principal and interest. So if we wanted to have one discount point, the fee was $4,236, which is less than that $4,500 credit left over. So the seller can fully pay that, and that would bring the interest rate down to 4.3%. 3.75%. So we're talking almost half a point there that we're dropping it down by. So that would make the monthly payment $1,732. So like 70, 80 bucks less than that. However, we'd be leaving about $300 on the table. So not a huge amount of money, but still $300. But the next option we discussed, or the loan officer discussed with the buyer, was that, hey, buy down another discount point for $6,200 total for the previous one and this one. So the seller would pay the $4,500 credit left over, and the buyer would have to pay an additional $1,700. So our buyer said, yeah, that makes sense because I'm not having to bring $5,000 to closing. Right. I can just bring $1,700 instead and get my point down a whole, half a point there. We went from 4.75 to 4.25. And so for some good negotiating, a little bit of money to the table, less than we expected, the overall principal and interest payment is now $1,706. So if you're a house hacker, and a lot of times, after a year or two to move out, we're talking $100 and change difference in your monthly mortgage payments. Well, that can have a big impact on that year 2 and year 3 cash flow when you move out, when your cash flow margins are going to be tight because you put such little money down, and Denver's prices are going up. So we went down with that option. Joe, what are your thoughts on that? What do you typically see? Is this kind of pretty normal?
Spot on. Yeah. This is exactly what I would see. I would say option number 2 is definitely better because you're going to get a little bit more money out of the pocket of the buyer, but you're getting a full 0.5% down at a cost of only $1,700 out of the buyer's pocket. The other $4,500 of that $6,200 was paid by the seller. So option number 1, yeah, you could do it, but that $300 goes back to the seller. I would rather spend a little bit more money out of my pocket as the buyer, get all of the benefit of that seller credit, and still get an even lower monthly payment. So I think this was a great choice to go with option number 2. Again, the only other thing I would say is maybe look at what it would have been with prepaid mortgage insurance. That might have saved some money as well. Depends on credit score, depends on the amount of the down payment. That's a popular question I get as well. How much is the mortgage insurance going to be?
Depends.
It depends. Let me ask you this. How much is my car insurance going to be? It depends. Right? And mortgage insurance is the same way. There's hundreds of variables that go into it. And so we would have just looked at it, or we did look at it on a case-by-case basis. And I think option number 2 ended up being the best one.
And that's exactly when the buyer went. She's like, yeah, option number 2, no brainer.
Great.
So that's what she went with. All right. So let's look at some numbers here. And this first screenshot we're looking at of Joe's cash flow calculator investment spreadsheet. We are putting in rent of $1,500 for one, kind of like the upstairs or downstairs of the house. And actually, I think the owners, their plans to live upstairs. They're doing some work downstairs, just touching up all that like silly cosmetic stuff that the owners kind of half did. They added an egress window. They did a couple updates down there. So doing a lot of the work themselves, but probably with the egress one and everything, it's, $5,000, $6,000 worth of work plus some nights and weekends for them to do some stuff. And they're hiring out like the egress window and things like that. So they are expecting to get $1,500 a month in rent for 2 bedrooms, a bathroom, and a really good living space. So if you put that all in here, $15 a month in rent while they're living there. The other numbers are their taxes are about $1,800 for the year. Property insurance is about $1,500 for the year. We put $900 in repairs and maintenance. Water and sewer, $1,500 for the year. Trash, $400. Electric, $1,500 because they'll just be paying the utilities and incorporating that into the rent number. So while they're living there, their annual cash flow is a negative $10,000 a year. So that's about $850 a month that they are losing. If you look at on the spreadsheet term, or the other side of the coin is that they're only spending $850 a month to live in a house, which you can't, that's about what it costs to rent a room in a house now around Denver. And they get a kitchen, 2 bedrooms, a bathroom, and a great living space.
Yeah. For $850 a month, that is a smoking deal.
So that is the way we look at while they're living there, and their plan is to stay there, about 1 year. And then, boom, house hack number 2, because she's a very savvy investor and she knows what she's doing. So when they move out, I kind of did some really quick rental numbers. Now, if they decide to rent it out room by room, they can definitely increase these rental numbers by saying, let's just keep it simple. Let's just rent the house out as is to a family. Hey, a 4-bedroom, 2-bath house in that part of town with some updating they'll do. We'll probably be right around $2,200 a month in rent, give or take a few bucks. Might be a little bit higher since we're going to be looking at a year or two in the future. And rents, Joe, generally go up every year.
Generally up.
Yeah.
Yep.
And they might be, not going up as fast in the last couple of years, but over the next 10 years, rents will go up.
Going to increase.
But as you said earlier, your 30-year fixed rate mortgage payment stays the same.
Yeah. Where's that here? This mortgage payment doesn't go up.
Yep.
Taxes, insurance, those can go up. This number doesn't change, guys. Don't refinance if you don't have to. I mean, maybe you want to take some cash out or whatever, but this is a fixed payment for 30 years. That payment is going to be ultra low 15 years from now, right? As rents continue to go up and the value of that home continues to go up.
And their payment was saying, we said $1,706 a month.
Yeah. The payment is actually insanely low right now.
Yeah.
Right.
I know.
But in 15 years, it's going to be really low.
So again, now when you're plugging these in a spreadsheet, we said $22 a month in rent, since now they are not living at the property. They're in house hack number 2. Taxes are $1,800. Property insurance is $1,500. Repairs and maintenance will go up. We did, I think, 5% estimating the monthly repairs, because while they're living there currently, they're going to do a lot of little touch-ups and fix things to make it very tenant-proof and easy to manage down the road. Well, then all the utilities we talked about previously, we will shift those to the tenant. Maybe they'll cover water, maybe they'll cover trash, but these numbers will be pretty similar, but not paying electric, they're not paying gas, they're not paying a lot of those items. So if you look at all that, their net operating income is going to be about $21,000. So that is your rent, your annual rent minus your annual expenses, leaves you your net operating income of about $21,000. Less the mortgage payments of about $20,500. So you now have an annual cash flow of about $500 per year on that property. Okay, so $500, no one's retiring on that per year. But here's the thing. They bought this house for 5% down. And that's also including putting some money aside every month for repairs and maintenance. So if you actually want to then, because also what happens once you move out of the property, Joe, you're no longer the owner occupant, but now you're a landlord. Mm-hmm. What other benefit do you get when it comes to investing?
You get some really good tax benefits like depreciation, writing off the interest. So here's a really common one. I'm not a tax accountant. I'm not a CPA, so nobody sue me over this. But as you're living here, your standard deduction on your taxes is, what is it now? It's like 21 or 26,000 or something.
For individual.
Right. So you're probably not writing off this interest when you're living there, because a portion of this payment is principal as well. So you probably don't have enough interest to write off and be greater than your standard deduction. So you're probably using your standard deduction. But once you move out, this interest now goes on your Schedule E as an expense that you can get tax benefits on. Also, you can depreciate the property. You're still getting principal reduction every month. And who's paying the principal reduction, Chris?
Your tenants are.
The tenant is. And you have the value of the property continuing to increase. So the moment you move out of this becomes a very, very tax favorable investment.
Yes. And I mean, just doing some really quick numbers in my head. So again, do not bet anything on this, but just doing some really quick depreciation numbers in my head, they're probably getting right around about a $10,000 a year depreciation benefit.
Probably about right.
And then you don't get $10,000 off, but you basically take $10,000 times your tax brackets.
Yep.
So let's just say 20%, between Colorado and federal. So that's $2,000. Well, that's going to be $2,000 back in your pocket, whether that's part of a refund or just offsets other income or other taxes you were owing. But you had that cash flow there. Oh, great. Now we're only like $2,500 a year in annual cash flow, which is a huge win in my book, because you bought a great asset in a great city like Denver for 5% down, and rents will go up, expenses will go up some, but your biggest expense of that 30-year fixed mortgage stays the same.
That's right.
So the next property we're doing is actually a rental property in Aurora. And I picked this one on purpose because I really actually want to do a quick comparison of the two at the end of the roundup to kind of give you some ideas of the numbers of what it looks like on house hacking versus buying, one of the better cash flowing properties you can get as investment here in Denver. So, Joe, this is a property that you closed on.
I did.
So it is near, I was not the agent on here, but Joe was the lender. It was near Florida and Parker in Aurora.
Yep.
So 1 bedroom, 1 bathroom, and the HOA is a whopping $108 a month.
Yep. And just to be clear, I was the lender when you said I closed on it. I didn't buy it,
yes.
But I was the lender. And yeah, terrific property. Wait till you guys see the price. You're gonna be blown away. People tell me all the time, homes like this are not available. They're not on the market. What do you know? Right here, $100,000 purchase price. These are the costs for taxes, insurance, title. These are the costs for the new loan. They put $25,000 down. Needs a little bit of repair. Needs paint, carpet, and I think a little spruce up in the kitchen. 5.25% interest rate for an investment property. Yeah.
Go back up here. So why are they putting 25% down on that when it's only $100,000?
Sure. So minimum down payment you can do on an investment property is 15%. Because they're not living there. It's not a house hack, right? You could also do 20% or 25%. But the difference you're going to see is right here. Your interest rate and your closing costs are going to increase when you're doing 20 or even 15% down. So if they were doing 15% down, this would have been a rate closer to like 6%. And their loan costs would have been, our normal processing cost plus probably 2 points. All right. So for a loan this size, it made sense for them to just invest more money on the principal versus trying to minimize their $25,000 down payment. Now, that doesn't mean it makes sense every time to put 25% down. We have to analyze it. We have to look at it. We go through it with the client. And when I sat down with these guys, we looked at the 15, the 20, and the 25%. The 25% made the most sense.
And I'm guessing this was probably a condo that required 25% down. Do you remember?
Actually, that's true. Yeah, it
and
was.
That's what a lot when we've seen Aurora. They are investor complexes.
That's exactly right. Yeah. So sorry, I got off on a side note, but you're right. This actually did require 25% down due to the HOA. And we look at all homeowners associations on a case-by-case basis. This one had pretty high investor concentration, but we can work with that if you're doing 25% down, but not with only 15 or 20%. So you're exactly right. That was the determining factor there.
So overall, 25% down, so $25,000 down payment plus about $5,000 in closing costs, $4,000 in closing costs, and then $5,500 in estimated repair. So about $110 all in.
Yeah.
Or, I'm sorry, $110 purchase price, but then about $34,000 all in cash out of pocket.
Exactly. Yep. And they did a regular conventional loan, 5.25%, 30-year fixed. Now, one of my favorite pieces of feedback that we get online or that we get in our classes is, I'm not buying a property unless it's a 1-to-1 GRM or a 100 GRM. So those of you that aren't familiar, that means a $100,000 property should generate $1,000 a month in rent. Or if it's a $200,000 property, it should generate $2,000 a month in rent. Or $300,000 property should generate $3,000 a month in rent. Now, Chris, do you see a lot of these anymore? Do you see anything that has the 1% rule?
No, we see those very rarely. Yeah. And we definitely see them. And there's a reason it's complex is $100,000 for unit. It's
absolutely,
it needs some love.
Yeah. It's not the most gorgeous thing ever, but you know what? It's not where I'm going to live. It's where the tenant is going to live. And guys, these are out there. You know where they found this property, Chris?
They knocked on 300 doors.
They did not knock on any doors. Try again.
Let me guess, the MLS.
It was on the MLS. You know how long it was listed on the MLS?
Man, these are leading questions here. 22 days.
114.
Wow.
Yeah, 114 days on the MLS.
Was this so overpriced? Remember?
That I don't remember.
Okay.
Yeah, because to be frank, I don't really get involved until we're under contract, right? So I'm not sure what the details were. Taxes, insurance, super low. They even have
read those numbers,
management.
Joe, for the people listening.
Yeah, $362 for taxes, $180 for insurance, property management, 10%, $1,200 a year, $600 repairs and maintenance. And then HOA, $108 a month times 12 is $1,296 a year. So not very expensive for the overall expenses on this property.
No, I mean, and if you're looking at straight investment property, this is about the lowest price point and the lowest cash out of pocket you can get. I think I've seen one other property that was not just a total mess, that was actually less than $100,000, and that was like $90,000. But you're talking a few dollars less out of pocket. So, if you want to buy an investment property, this is about the lowest cash out of pocket that you can find in Denver.
Absolutely. Yeah, we are looking at some properties in Colorado Springs. We're actually doing a property tour down in Pueblo this weekend. And there are some lower price properties there that require a little bit less out of pocket. But one of the challenges that you have to factor in, if I'm driving to Pueblo, I need to put in here travel, right? If I'm managing it myself, I need to budget my travel for my time and expenses.
Yep.
So just keep in mind, you got to compare those. But there are some lower price properties. But here in Denver, this is going to be a really good example.
And that's actually, I wanted to let me finish up the slide before kind of bring some parallels between here. So once you bring in the rental income minus the expenses, we had about a $7,762 net operating income. So your total rental income over for the year minus your annual expenses, and then minus your mortgage payments, about $5,000, you get an annual cash flow of about $2,800 a year. So that is definitely a higher than the house hack we saw. And then this puts it right around a 7.4 cap rate.
Mm-hmm.
So, and as you said earlier, we're at a GRM, 105, so right around 100. So once you count closing costs and repairs, we're like 105.
Yeah, this factors in that $5,500 of repairs because that's CapEx expenses.
And so a discussion I have a lot with investors, actually a lot of people on Bigger Pockets and different internet forums is, people say, oh my gosh, Denver is so expensive. I'm young. I want to invest out of state just because prices are so expensive. I'm like, okay, I understand that. Hey, your money, it can be cheaper down payment out of state. And a lot of times those numbers are like this $100,000 price point we're looking at, or $100,000 to $200,000. So it draws a very good parallel for how much cash it would take. My first question is always, okay, well, where do you live now? And a lot of times they're renting. Well, you always have to have a place to live. And hey, I know some people living with their parents. Cool. I did that for a while to save money. And I think it's a great way to do it. But that's usually not like a long-term solution. But most people want to, get it on their own. So that comes in. Then I always have a discussion like, great, well, you can invest out of state, which has various pros and cons. And we'll actually be doing some upcoming podcast on what it really takes to invest out of state. So be on the lookout for that. Definitely knowing pros and cons, but then when you actually compare the numbers on what you need to do house hacking here in Denver, it becomes a very interesting question. So just running these two scenarios we have here, this rental property of $100,000 in Aurora required $25,000 down payment, about $5,000 in closing costs, and about $5,000 in repairs. So that's a total out of pocket of $34,000. Great. So if you're investing out of state, you can probably buy a place around that same number, same price point if you go down Pueblo or whatever.
Yeah.
So about $34,000 out of pocket. Now on that house hack we talked about, we were at $18,000-ish down payment, 5% of the purchase price, plus $5,000 in closing cost. And I'm assuming that, hey, we always don't get $9,500 back in seller's credit. So I'm actually saying, hey, typically speaking, we don't get that. You're still having to pay closing costs here to be a normal deal. So I'm actually adding that back in here to try to be an apples to apples example. So $18,000 plus $5,000 in closing costs. And then they're doing about $5,000 in initial repairs, which is like that cleanup stuff. And then the biggest expense is adding the egress window, which is like $3,000 and change. So overall, $18,000 plus $5,000 plus $5,000 is $28,000. So they're actually, if you're house hacking, you're actually able to buy a much more expensive asset in a great city for less out of pocket. Now, no offense to other markets out there, but I know a lot of like these cash flow markets people invest out of state. I have no doubt in my mind that in 30 years, I would rather own an asset in Denver versus an asset in Tennessee or Ohio or somewhere I never go.
Yeah.
Joe, what's your opinion on that?
My ankle bracelet goes off if I cross E470. Like it just, I don't know, man. If you travel to Atlanta on a regular basis, maybe you have family there. Okay, great. That's reasonable. But if you're not already traveling to that area, you've got to add that into your expenses, right? It's going to cost you. You got to go there once a year, twice a year. Best case, that's going to cost you $1,000.
That's best case going out there once or twice a year.
Right? I don't know. I get this question a lot. Do I invest out of state? I don't, guys. I don't. And the story I always use, Lon had a great example. He had a property down on, I think it was 14th and Clarkson. It was a multi-unit, and he had a property manager, because that's what everybody always says. Oh, I can invest out of state because I got a property manager. Okay, great. Well, he had a property right here in Denver. He had a property manager. He never went to it, never did anything with it. Lon, he never did anything with it. The property manager handled all of it. One evening, about 2:00 in the morning, the police called him and said, hey, do you own, 123 Clarkson Street? He said, yeah, I sure do. What's going on? He said, well, there's someone drunk on top of the building, throwing stuff off the building. And he said, well, hey, I have a property manager. Call him. And they said, well, we have a problem. That the person that's drunk throwing stuff off the building is the property manager. All right. So the property manager was on the wagon and had gone off the wagon, or vice versa, whichever the bad one is. All right. What if that would have been in Atlanta? It would have been really difficult for him to get up, get out of bed, get on an airplane, fly over there, get that dealt with. But what did he do? He got up, put on his clothes, drove down there, went with the police, got the guy off the roof. He had to manage the property for a week, a month, whatever, till he got a new property manager. That would have been extraordinarily difficult to do 2,000 miles away. So again, I'm not saying don't do it, but I think you need to go into that with your eyes wide open if you want to start investing out of state. And it's not for me.
Yeah, I agree. And like I said, I know a couple very successful investors here in Denver that invest locally. They invest out of state. And I'm doing a few future podcast episodes because they're going to tell you exactly what it takes to invest out of state. And it was way more than 1 or 2 flights a year.
Yeah.
It was like 1 or 2 flights a week at times.
Yeah.
A quote I always go back to, I'm a big Warren Buffett fan, even though, he stocks and everything, but he's just, I think, a brilliant mind. One of my favorite quotes from him, and this is me paraphrasing it, is, I would rather buy a great asset at a fair price than a fair asset at a great price. And that's how I relate Denver to all the out-of-state markets, because I really think Denver is a great market now and will be over the next 30 years. And so with these two scenarios, and I'm really talking to a lot of like young people out there that are kind of debating this right now, to me, it is definitely a no-brainer to house hacking. Of course, you guys got to do what's best for you, but look at these numbers, listen to these pros and cons, and really figure out, hey, what's going to make the most sense? Because as you're learning how to be a landlord and manage properties, it's a lot easier to learn everything and make your mistakes, because it's a matter of when things go bad, not if. It's always when things go bad. It's easier to do it when it's your property you're living in, or it's a property you lived in. You can drive 20 minutes to go check it out and deal with it.
That's right.
All right. So to recap those numbers, it was about $34,000 all in for the rental in Aurora, and it was about $28,000 all in with the place in Westminster, the house hack. And if you actually take out that seller's credit, it goes from $28,000 to like $23,000. So still, that's just an insanely low number to go out there and buy a $350,000-ish asset that will be slightly positive cash flow when you move out. Like, that is just so mind-boggling to me.
Yeah, absolutely.
All right. So, we forgot one more slide on here, Joe. I don't know if we need to touch on this. Is actually the closing statement.
Yeah, closing statement
in Aurora. So we'll skip that. We already touched on the numbers.
Yep.
About $5,000 closing costs. All right, everyone. Well, that wraps up this month's Roundup webinar. So we got some classes coming up and some other webinars. So always go to denverinvestmentrealestate.com/calendar to see whatever classes and webinars that we have up and running. So on May 8th, Joe and I are teaching an in-person class called the BRRRR strategy. So buy,
buy rehab, rent, refinance, repeat.
See, the problem is,
it's a cool strategy.
If I have to say this, it's like doing math in front of the classroom live. Right, if I have to say that live, I screw it up.
It's the BRRRRRRRR. Just repeat it nonstop.
So May 8th, May 21st, I'm teaching my favorite class with Joe, house hacking. And then we're doing a property analysis spreadsheet May 22nd. And we're teaching their class, how many properties do you need to retire on June 4th. So check the calendar for those. Also check the calendar for other webinars, future Roundup webinars, future webinars on taxes, future webinars on ADUs. We got a lot of cool content coming up. All right, everyone. Well, that wraps it up. Again, my name is Chris Lopez. I'm an agent here at Your Castle and would love to help you buy a house hack or rental property. And Joe Massey is an incredible loan officer over at Castle and Cook, and he will get your loan done.
All loans all the time. Would love to chat with you. Any questions, call, text, email, send a carrier pigeon, whatever we can do to help. Thanks so much for listening, guys. Look forward to seeing you next month.